Right, Lamai, today we will discuss question number 87 numbers in our MCQ class. So then look at the question number 87. Right, you need to adjust this 300,000 as 30,000. Please remove 10. Right, look at the question. The total assets of Shamani's business as at 1st January 2024. Total assets of Shamani business 1st January 2024. Total assets 300,000. And as of 31st December 2024, total assets 600,000. Total assets 600,000. The owner says that closing liabilities are higher than the open liabilities by 75,000. The owner has invested 150,000 as additional capital. She has taken 30,000 for her personal usage. The liabilities as at 1st January 2024 was 150,000. Calculate the profit or loss for the ending 31st December 2024. Right, insurance in this question, opening liabilities 150,000. And then examiner says that closing liabilities are higher than 75,000. Okay, closing liabilities are higher than the opening liabilities by 75,000. Then closing liabilities of the business 225,000. 225,000. Okay, right. Now you can calculate opening equity of the business organization. Opening equity, opening net assets 150,000. And then students, closing net assets of the business organization, closing net assets 375,000. Closing net assets 375,000. Right, then we'll calculate the profit of the business organization. Profit equal to closing net assets 375,000 minus opening net assets 150,000, and then additional capital 150,000, additional capital 150,000 minus additional capital minus, and then plus drawings 30,000. Right, now you can calculate the profit or loss of the business organization. How much the profit? Profit is 375,000 minus 150 minus 150 plus 30. Profit 105,000. Profit of the business 105,000. Okay, profit of the business 105,000. Right. Students, look at the question number 88. Look at the question number 88. Right. The petty cash at the petty cashier as at 1st March 2024 was 1,250. Opening petty cash balance. Opening petty cash balance 1,250. Okay. Petty cash account opening balance 1,250. The cash reimbursed to the petty cashier as at that date was 6,750. Main cashier reimbursed 6,750. Right, then petty cash interest amount is how much? 8,000. 8,000. Calculate the petty cash interest for the business 8,000. Petty cash interest of the business 8,000. Second one, calculate the petty cash expense in the month of February. In the month of February, petty cash expense is how much? 6,750. Okay, February month, petty cash expense is 6,750. Okay, and then answer for the question number 1 is petty cash interest is 8,000. Second one, calculate the petty cash expense in the month of February 6,750. Okay, right. Look at the question 89. Question 89. State 4 items which are adjusted in cash control account when reconciling the balance of the cash control account with the balance of the bank statement. Okay, the transaction that we record in adjusted cash control account. The restaurants are standing order payment, bank charges, deposited and discharged check, issued and discharged check, direct remittances. Another one, errors done by the business. Errors done by the business. Right. Question 90. Question 90. The balances of debtors control account of Chamat business as at 31st March 2024 was 100,000. Debtor balance as at 31st March 2024 was 100,000. 10% should be allowed for impairment loss on trade receivable. Complete the following table by using the above information. First one is allowance for impairment loss at the first time. Allowance for impairment loss at the first time. We are going to make a provision. Okay, they are going to make an allowance for expected loss. There was a double entry. Okay, students, right then here, first time allowance for expected loss. In company accounting, first time allowance for expected loss we debit into impairment loss account. Now, how to write the double entry for the question 90? For the question 90, impairment loss account. Impairment loss account debit how much? Debit 10,000. Impairment loss account debit 10,000. Allowance for expected loss account credit 10,000. Impairment loss account debit 10,000. Allowance for expected loss account credit 10,000. Right. Double entry for the first one. B. If the balance of the allowance for impairment loss account as at 1st April 23 was 8,000. If opening balance is 8,000, the difference 2,000 should be charged to profit and loss. Okay, the difference is 2,000. Then double entry for the 2,000. Impairment loss account debit 2,000. Impairment loss account debit 2,000. Allowance for expected loss account credit 2,000. Okay, impairment loss account debit 2,000. Allowance for expected loss account credit 2,000. Answer for the B. Answer for the B. Right. Right. So let's look at the question 91. Question 91. Right. The following information relates to building of Lasit's business as at 1st April 2024. Cost of the property building 800,000. Accumulated depreciation opening 160,000. Annual depreciation 10%. There is annual depreciation 10%. It means annual depreciation expense is 800,000 into 10%, 80,000. Now 80,000. Like then annual depreciation how much? 80,000. 80,000. Useful lifetime. Useful lifetime 10 years. 10 years. Okay. If the depreciation rate is 10%, useful lifetime 10 years. Then accumulated depreciation as of 31st March 2024. Opening depreciation 160,000. For their depreciation 80,000. Then total depreciation how much? Total depreciation 160,000 plus 80,000, 240,000. 240,000. Then carrying amount. How much the carrying amount? 800,000 minus 240,000. Carrying amount is 560,000. Carrying amount is 560,000. Annual depreciation 80,000. Useful lifetime 10 years. Accumulated depreciation 240,000. Carrying amount 560,000. Right. Look at the question 92. There can be errors and omissions even though the balance of the debtors control account agree with the total of the debtor list. State two types of such errors. State two types of such errors. There can be errors and omissions. Right. Debtor control account balance equal to debtor list balance. But there can be some errors. For example, here you can write down the Omission of a transaction, omission of a sales invoice. Omission of a sales invoice from financial statements. They were unable to record one of the sales invoice. Omission of a sales invoice from financial statements. Another one, recording incorrect value in sales journal. Recording incorrect value in sales journal. Recording incorrect value in sales return journal. Return outward journal. Sorry, return inward journal. Okay, recording incorrect value in sales return journal or sales journal. Right. Right. The insurance in these in those situations, although debtor control account balance equal to debtor list balance, okay, but errors can be seen in control account and debtor list balance. Right. 93. State two situations of reconciliation statements are prepared. Bank reconciliation statement. When preparing bank reconciliation statement, when preparing debtor reconciliation statement, and then when preparing creditor reconciliation statement. Right. Some of the situations where we prepare reconciliations in account. Okay, right. Question 94. Look at the question 94. 10,000 rupees has been paid for the insurance expense of Sanira's business in the year of 2024. 10,000 has been paid for the insurance expense. Right, okay, paid amount 10,000. The prepaid insurance charges 1st April 24 was 2,000 for the payable insurance expense is 31st December 24 was 3,000. Calculate the insurance expense relevant for the accounting year. Question number 94. Question 94. Question 94. Right. Insurance expense paid amount 10,000. Insurance account. Insurance account. Cash book credit. Insurance account debit 10,000. Paid amount in cash. And then insurance charges 1st January 24 was 2,000. A prepaid insurance charges. Yes, prepaid amount. Opening balance 2,000. And then payable insurance 3,000. At the end of the year, payable amount 3,000. Balance carried down 3,000. Balance brought forward 3,000. Alright, calculate the relevant insurance expense for the period here. 15,000, 15,000, 50,000 transfer to profit and loss, profit and loss. Relevant bank loan interest for the period is 50,000. And then second one, state two accounting concept relevant for the above calculation. Two accounting concepts, accrual concept and matching concept. Accrual concept and matching concept. Right. Right, students, question number 95. Look at the question number 95. True or false? Right. State whether the following statements relating to a sole proprietorship are true or false. First one, related to sole proprietorship business. Drawing should be deducted when calculating the profit or loss according to profit equation. False. False. The total of the invested capital and retained earnings are equal to equity. That is correct. This is the sole proprietorship business. So that is true. True. C. Drawings are recognized as an expense. False. False. C. False. D. Matching concept is used when preparing income statement. Yes, correct. Correct. Right then. False. True. False. True. That's the answer. Right. Answer for the question 96. State how the following transaction of a business will affect to equity, increase, decrease, or no change. Right. A. Settling. It should be settling. Settling a bank loan of 50,000, including an interest of 5,000. Equity decrease. Equity decrease. Second one. settling the advertising expense of 20,000 of a business by owner's personal money. Here, equity increase or decrease? Equity, no change, no change. Expense increase, equity, expense, okay, 20,000 plus expenses minus, sorry, expenses, okay, here 20,000, right. Okay, look at this one. Okay, because of this transaction, okay, in equity, because of this 20,000, equity increased by 20,000. But on the other hand, because of an expense, again equity decreased by 20,000. No change to equity, no change. Okay, right. C, receiving a discount of 2,000 when settling a creditor, equity increase. Donating stock worth of 10,000, equity decrease. Right, now my question number 97, look at the question number 97. State two exception to historical cost concept, two exception. Two situations where you violate historical cost concept. One is revaluing property, plant and equipment. Other one is calculating net realizable value of stocks, inventories. Okay, net realizable value of inventories. Other one is revaluing property, plant and equipment. Two situations where you violate historical cost concept. Right. Right, Lamai, we'll stop for the day. From next video, we'll discuss question 98 onwards. Thank you.